Thank you to the audience that you're here. We have a great panel here today. It's investors' response to water-related risks. Actually, we would need a chair with a little can saying Heineken because he's missing. Unfortunately, it could be that he's walking in. We will then have him join in the panel just spontaneously. Wonderfully, Kajetan was able to help us on the panel to complete a bit more that what was a bit missing now, because we do have different topics like analysis of data, we have awarding of transparency, we have investment perspective, and we now have a... Kajetan, would you explain your role as a water expert?
Yeah, so having seen various fields of water, so worked for quite some while in ESG investment and also took up water, initiated 2 water funds, one for ASN, stock listed, and the other one I was supposed to manage by myself, which was targeting non-listed investments in water and sanitation. Then moved on to the 2030 Water Resources Group, which is much more political, creating enabling environments, working with governments, with multinationals, with multi-stakeholders, and recently joined an NGO called Waste, who is working on business development and how to move on to scalable, investable projects.
Thank you, Kajetan. Cate Lamb, Head of Water.
Shall I give a quick overview? Okay, so for those of you who may not have heard of CDP before, although I'm hoping most of you have, we used to be the Carbon Disclosure Project. We provide the only global platform for companies and cities to disclose standardized information about their environmental impacts and associated risks. We have a climate change program, a deforestation program, and a water program that I'm very lucky to direct and head up. I'll be talking today, giving a general overview of the work that we do and how transparency ultimately drives change. We are an international NGO with a core mission, but we work, and we have worked for the last 14 years with many institutional investors around the world, as well as the corporations that are highly dependent upon water.
Cyrus?
I'm Cyrus. Hi, thank you. I'm Cyrus Lotfipour. I'm from MSCI ESG Research. My official role within MSCI is actually the sector lead for capital goods and chemicals research. But my role here today is part of my water role within MSCI, which is mostly dealing with how we assess companies on their risk exposure to water scarcity risks. We primarily provide data and tools to institutional investors who are looking to integrate environmental, social, and governance indicators into their investment process.
Thank you.
And I'm Piet Klop. I'm with PGGM Investments. We try to be a responsible investor for a couple of pension funds. The biggest by far is the pension fund for the health and welfare sector in the Netherlands. There's a ton of money there. My role there is the resident water guy, at least for the purposes of this panel. So we try to avoid water risk, and more recently we also try to pursue water-related opportunities, which is much easier to talk about than to actually do.
Thank you so much. So this is the panel. What we will do with the structure, my name is Daniela Herrmann. I'm the founder of Topan. We make dollars and cents somehow. And yeah, the rest is on the webpage. So I would like to structure this panel the following way, that we first try to actually gain a certain kind of same level on knowledge. So this would be that each individual is going to help you on a little road or let's say, voyage on their themes that they're in, day out. And afterwards, we're going to summarize it all to questions that pop out. Now, I find panel constellations almost old-fashioned a little bit, because we're sitting here and you're sitting down there, and if you think of the trend of open source, it would more be that you come up here now, but we won't do this now. So my really demand to you would be, please, if you add questions or add knowledge, there's always a little time. We don't have 2 hours, but we have a little time to add to the knowledge to the panelists or add to the questions that are asked. So please be open, spontaneous, we love it. Thank you. So I would like to start maybe with Cate, please, to help us understand a bit more what you're doing day in, day out. What are your, confrontations with companies, maybe add a little bit more to companies, as we have Heineken missing, which would have been a wonderful insight from the company perspective. That would help.
Okay, sure.
Thank you.
As I mentioned earlier, CDP has been operating a disclosure platform for 14 years now. And about 4 years ago, we decided to venture into water, recognizing that global corporations have responsibilities and opportunities to be gained from tackling the global water crisis. They're a huge and powerful and engaged group of organizations that have, or actors, shall I say, that have perhaps traditionally not been viewed as an actor in solving the water crisis. It's been typically left to governments. So we felt that we could start by asking some key, relatively, what on the face of it appear to be simple questions to these corporations to spark a reaction and gauge what's happening in the marketplace. One of those questions is, are you exposed to water-related risks? Which, as I say, sounds quite simple when you first hear it, but of course, finding an answer to that is definitely not easy. And we found, or quickly discovered, that for many of the corporations that we were engaging with, this was a totally new question. They didn't have systems in place to collect the data that was needed to inform the answer that we were asking of them. They didn't know which tools to use to assess that. In fact, in some cases, there were no tools. There is no standard approach to assessing corporate water risk exposure, which, of course, relies so much more than just how much water do I use and where is it coming from. So we've been on this journey, and I think it's important to recognize that most companies are also on this journey. The water program started 4 years ago, and we're now operating on behalf of 570 investors with around $60 trillion worth of assets. That number's more than quadrupled. In fact, it's an increase of 400% in 4 years, so I'm very proud of that. And similarly, the number of companies that are disclosing to us has also increased dramatically over those 4 years. In fact, this year, the numbers are just in. We launch our global findings next week in Barcelona, but we had over 1,200 global corporations disclose information. Now, that data is, some of it is amazing and perfect, some of it is not so great, and not an awful lot to be said about it necessarily. However, we want to reward transparency. We want to make sure that companies understand that it's okay if they don't have all of the answers, that sometimes telling you as an investor that I don't know yet, but this is what I'm doing about it, is often better than not disclosing at all. So we had 58% of the global 500 target companies disclosed this year, which means actually 42% failed to disclose. And that's going to be our topic of engagement over the next year, is trying to work out how do we increase that number of companies, and we would love to work with many of you in the room to increase the transparency overall. Of the analysis that we've undertaken, 64% of the companies that have disclosed are reporting that they're exposed to substantive risks. So they're not risks that you can sort of deal with on a day-to-day basis. These are risks that may cause a substantive change in their business operations or revenue. And there's something like 670 reported overall out of 174 of the global 500 companies. It's an average about 4 substantive water risks per company. The majority of those risks are anticipated to impact either now or in the next 3 years. Quite encouragingly, however, more companies, so 75% of those same companies, recognize that water scarcity and stress and other related issues are likely to result in business opportunities. That is from cost reduction, striving for efficiency, but also greater shareholder confidence and the sales of new products and services. We believe that transparency does drive change in the marketplace. We want our data to be used by as many organizations, including the likes of MSCI, PGGM, as possible. Next year, we'll be introducing a corporate scoring methodology. So it'll be a water score. You may be familiar that we have a climate change score for corporations. Next year, we'll be introducing a formal public water score, and we've trialed it this year, and we've recognized that if nothing else, the quality of the disclosures has increased really quite dramatically. So we think that 2015 and onwards promises to be a really great year, and we hope to see greater levels of transparency on this issue so that you can move forward and the companies can move forward with more confidence.
Thank you, Kate. Cyrus, please. give
actually,
us...
one additional question I have for Cate is, and this would have gone perfectly for our representative from Heineken, but I'm wondering, what is the primary motivation for a company to start disclosing? What is the primary barrier for a company to disclose?
That's a great question. Let's start with the barriers first.
Yeah.
I think there are a number of reasons why companies choose not to disclose. Partly they're a little bit afraid, I think, putting this information out in the public domain, saying that actually we know there's a problem, but we're not quite sure what we're doing about it yet, is really quite a brave move, particularly for companies in, say, emerging economies. We find that in India, particularly, companies struggle with being transparent on these issues, even though they might know it's an issue. Equally, the environmental reporting teams are they don't have enough staff and resources. You have one person in some of these companies that are expected to disclose to 3 questionnaires from CDP, 1 questionnaire from DJSI, 1 from GRI, plus the annual reports. It's a huge burden for each of these teams. And again, I think that partly reflects whether or not ESG reporting is viewed as strategic and core business, or if it's still the nice to do. One of the many benefits that we hear from companies, well, there are 2 that I would talk about, is first of all, shareholder confidence. So a lot of them get it, which is great. They understand that many of the data points that are used are being used by the investors, and I work very, very hard to build that business case all the time. So you'll read in our report this year, there's a lot of case studies and quotes from the institutional investors who are using the data so that the companies feel that feedback and feel that love in a sense. And the second part is the benchmarking that we're now able to provide. We did actually have a number of companies threaten to stop disclosing until we implemented water scoring. That in itself, I think, will be used as a very powerful tool to enable them to move forward and take a much more meaningful and effective journey towards becoming better water stewards.
Great.
Thank you, Cate. Shall we first have you from the investment perspective, and then Cyrus, or Cyrus, you want to go first?
Well, I can go on. I think it's a good transition point, actually.
Good.
MSCI, we provide a lot of environmental, social governance research to help investors like PGGM and Piet and his water crew to integrate these kinds of factors into their actual investment process. But one of the challenges we face is actually exactly what Cate was mentioning, is that with water, it's such a local issue in that it requires a local analysis. But at the same time, it's hard to make such a localized analysis without compromising the scalability of the process. And MSCI is a facilitator of this integration. We are not actually integrating into the investment process. That's what we rely on Piet for. But we can facilitate his PGGMs and other fund managers. We can facilitate their integration of water factors into their investment process. And I think overall, the developing water crisis, especially in California, in the US at least, this is huge news. We hear about it pretty much every night on the nightly news about what is the water crisis in California and how is that developing. And in the US in particular, we're seeing a lot of movement from pension funds and asset managers who are now just beginning to consider this into their investment process. And these are actually from asset managers who might not have even known what ESG stood for in the first place. So we are seeing a lot of movement from there. And what it requires is this level of localized analysis that part of my role is. In the past, I've authored a couple of water reports, and this most recent one was received pretty well by the investment community, and it wasn't for the reason I expected it. What we did was that we needed to map company facilities to specific basins, specific locations, which is a lot harder than you would expect. And trying to figure out, well, not only what is their level of water stress, but what are they competing with? Who are their main competitors for water? And are they in major agricultural zones? Are they an electric utility that's competing for water with a pear farmer or a almond farmer? And when we know that a lot of the agriculture in the United States is focused in California, I think around 50% of carrots in the United States are focused on one specific county in California. Spain, for example, gets around 90% of its almond imports just from one region of California. So these factors will also bring into clear focus for investors, like exactly how important this conflict is. And so one of our main goals is to help investors integrate that into their process. So what we did was we actually were able to map company facilities, figure out what is their percentage of value of assets at risk associated with this agro-industrial water conflict. And then from there, we were also able to figure out what is that contrasting risk point. We have the company's point of view. Well, what is the impact on agriculture? And especially in Europe, I think this has been gaining a lot of traction because the agricultural component is really the biggest area of risk for European investors. Europe is not particularly known for being water stressed. It's not nearly on the level of the Southwest of the United States, regions of South Africa, regions of Australia, where water is a clear operational risk for mining companies, for electric utilities. But the main risk for European investors is actually how is this impacting the supply chain. So one of our main takeaways was that we not only wanted to focus on the facilities and the companies that are impacted, but we wanted to focus on what are the crops that are actually impacted. And this also would have been a great question for the Heineken representative here, but understanding more transparency in the actual agricultural component and the supply chain of impacts of water. Because that is essentially a hidden risk in the supply chain. And without adequate transparency from companies, it's very difficult to assess this kind of risk exposure.
I think, Cyrus, there it's maybe even better to move that certainly in what we discussed with the commoditization of data analysis
Exactly.
and the stress that you all are exposed to permanently deliver in very short time actually valuable attribution to investment processes, but we do have the problem that we have non-disclosure issues, and how do you manage that stretch, which is a responsibility that is probably not always nice to have.
Right. Well, in terms of the commoditization factor, I don't think we should necessarily look at that as a bad thing. Commodities are standardized, and standardization is what this industry needs. We need organizations like CDP, and we need ways to integrate standardized metrics into the investment process. So I would say commoditization is great. We need to have this kind of level of scalability in order to make it usable for the investment community. What MSCI at least tries to do is, in the absence of disclosure, part of our model is to look exactly at what is that risk exposure of each company. And for that, we need to know two basic ideas. And they're harder to derive than you might expect. One is exactly, well, what is the water intensity of the company's industries? For example, we know that electric utilities are way more water intensive than a chemical company or a telecommunications company for that matter. Similarly, we need to understand where exactly the company is operating and what kind of risks it faces. So understanding those two basic ideas, we're able to combine into an overall risk analysis that will enable us to get around this idea of non-disclosure, which is developing, but for most of our universe, which is around 5,000 companies, we don't have adequate information on how these companies are managing this level of risk exposure. So in that respect, it's the most important part is to actually understand what is that risk exposure in the first place.
Thank you, Cyrus. Any adding value questions to this? Please.
Question on risk. Risk mostly gets visible when you have an example where it really turned out for the worse.
Mm-hmm.
Have you an example of a company which really did not re-estimate its risk completely right and ran into problems?
I think we see examples of that operationally in the mining industry. They've integrated this risk into their overall planning process, and mining companies understand that water is a significant barrier for growth. And so we have companies in Chile, for example, building massive desalination plants, massive pipelines to help support their mines. So in that respect, they're actually mitigating that level of risk exposure. So we're not necessarily seeing this risk develop into a material cost as often in the mining industry as we see it in the electric utilities industry, which is by far the most intensive, water-intensive industry. Within the United States, at least, there are a couple of examples of thermal derating events where companies essentially need to reduce their capacity utilization of their power plants to stay within the operating parameters of local environmental regulations. During periods of drought, during periods of low water levels, electric utilities will commonly surpass the limits of what they can cool. If the water temperature that they're intaking in that plant is too hot, then they're not going to have the necessary capacity to actually cool it down. One such plant was with the Tennessee Valley Authority, it's a public utility in the United States, so I wouldn't expect many European investors to care about that. But for the US, it is a big deal because it's one of the largest generators. And for them, it's not only did they lose 40–50% of their capacity, but it was around 45 days when they had to reduce their capacity for that much. And that's not only in lost revenue from generation, it's also increased costs as a result of having to switch to more expensive sources.
Flexibility. Mr. Dickstein is here from Heineken. We very much welcome you. Our little panel is growing. No one else will come now, so no problem. All right, wait, I'll move. Okay, here I go. Okay, bye-bye. No.
Okay.
No, I'll stay here somehow. Okay, flexibility. I would say I'll quickly brief you. The audience has been listening to Cate Lamb, has been listening to Cyrus. We have done, has been listening to Kajetan, who has actually been helping us as a, let's say, joker man, right, for the water expertise, because we were worrying if you're coming or not. So we're extremely happy you're here. Everyone has done already given professional insight to the audience. We're now at Piet. Or shall I give him first? You know, you guys can fight now.
It was late, come on.
Okay, but you have the nicer socks on, so...
Exactly.
Why don't you go ahead? And then afterwards, Michael?
I was on a similar panel a couple of weeks ago in London, and you know, we'd gone back and forth on, if this is so important, how come no CEO really loses sleep over water, or water risk, or water scarcity? And then a guy in the audience stood up and said, well, maybe that's because it's also terribly boring. It's not. But it is important to try to understand why it's difficult for investors to see the materiality in water risk. And I think that's down to two reasons, really. One is that a lot of people still think that water could be the next energy. Well, it's not. Because water is far from being priced according to its scarcity. So there's no price signal. So it won't hit your financial statements the way energy already does. So that's one thing. It makes it hard for CEOs to understand, and for that matter, for a lot of other people. Second, it's hard to activate. And why is that? Because water is also not the next carbon. Carbon is a perfect commodity. Water is the perfect anti-commodity, because it all depends when you look at it and where you look at it. So these two things makes it really, really hard for investors to get a handle on this real-world issue. Now, investors, I've learned since I joined PGGM a couple of years ago, are, how can I say this? You know, they've got difficulty comprehending what their money really does in the real world. You know, the financial crisis, for all the damage it's done to us, I think did one good thing. It forces on us the obligation to prove our social utility again. Now, water could be a nice issue to look at from that point of view. We were not equipped to do that. PGGM itself, for all its responsible intentions, is an index investor. We invest in a... All right, I'll start again.
No, don't.
So PGGM is an index investor trying to be a responsible... Oh, that doesn't work either. You know, I can also just leave.
Yeah, we're trying to do this, actually, but it's not working. I'm just kidding.
All right. So PGGM is an index investor. That means that we invest in a basket of 3,000 companies that we ourselves haven't picked. Someone else did that. The only thing we can do is not invest in companies in that basket. So we can choose companies not to invest in. So for that kind of investor, it's really important what Cate and the CDP do and what MSCI and Cyrus do. What we need is data for 3,000 companies, please, that are relevant. So it's got to be about risk and not just about how many liters of water you've been using the past year. Nobody cares about that. So it's got to be relevant. It's got to be comparable. So we need to be able to compare companies within a peer group. And it's got to be covering the index. So we need complete, relevant, and comparable data. Now, that's hard to come by still. And that's for all sorts of good reasons. You know, water is a relatively new issue. And as I said at the beginning, you know, there's a lot of people still struggling to understand how this is going to affect them. Now, I do believe that we must be careful here. The NGO community, I think, has this habit of asking too many data, perhaps, from companies. And investors probably are guilty of that same thing, too. A lot of companies don't quite understand what we're doing with those data. Why this is even important. A lot of investors, you know, don't quite understand what that data is telling them either. They look at a lot of this stuff as the telephone book, you know. They see all sorts of numbers. They don't see meaning yet. So what we need to do, I believe, is be very selective. Look at water the way MSCI is doing. Look at it as an issue that puts a certain percentage of value of the company at risk. Value at risk to us is the currency of this debate. If it doesn't help us understand the value at risk, the percentage of value at the type of risk, then we probably won't spend a whole lot of time looking at it. So we've got to be selective. And I'm so glad that CDP made that explicit in its water information request. Value at risk. Then we can start collecting and comparing data. Then we can start separating the leaders, the less exposed companies, from the laggards, the more exposed companies, and perhaps do away with the laggards in this index that we're investing in. By the way, 50% of the world's money is managed through indices. So this is not trivial, you know, this is a problem that many investors face. Now, I do believe that for all the tension between trying to be responsible and investing in an index investing is still, you know, worth thinking about in the sense that we need scale. Right now, we're still, to me, in my mind at least, you know, we're still pursuing slow solutions to fast problems. And we don't do it at scale. This is the reason that I personally joined PGGM, because I thought there's a lot of money there, there's scale there. Now the scale is affected through these index investments that we do. So it's really, really important that within that index we can separate the good from the bad. And we need these guys to do so. We don't need physical leaders of water, we need value at risk. Maybe I should stop there and turn it over to Heineken, whether you think accordingly.
Yes.
Or whether you're still throwing the telephone book at us.
Probably too. Sorry. Please.
Well, good morning, everyone. I thought in this very, very long time in the airplane today, how I would actually... Can you hear me without that? Yeah, in the last row, can you hear me without that? How to introduce, how to get myself started here. And I thought, well, we are, within Heineken, we've got around 130 breweries worldwide, of which 23 are in areas that we label as water scarce or water stressed. So in those 23 breweries, we see a certain particular responsibility for us and a certain need for us to act. And we run water stewardship programs there. And on paper, a water stewardship program seems as easy as a flight from Vienna to Amsterdam. So here's that is supposed to land at 9 o'clock in the morning and eventually lands at noon. Sometimes the devil is in the detail, and sometimes once you start engaging with the local community, you start engaging with peers, you start engaging with the local government, you see that the devil is in the detail, and you see that all of a sudden things can become very complex. Unfortunately, I was not able to listen to the introduction of my co-panelists except for the last one, and what triggered me immediately there is that this kind of evaluation of water, the strategic evaluation of water. Well, to be quite honest, if you haven't understood in the beer business how important water is to your operation, you should probably leave this business very soon and go to steel or somewhere else. What I normally do is, and unfortunately coming from Austria, I could do this already for lunchtime. As we are here in the Netherlands, I have to be careful because during lunch people here tend to drink milk and not beer. But normally what I do is I take this, and now I need your imagination, and I invite you to walk this little example with me. Just imagine that this would be a wonderful glass of Heineken, and I normally raise this glass, and then I say, look, 95% of what you see in there is actually water. And what we make sure is, regardless of which part of the world we produce Heineken, we make sure that the Heineken recipe is unique, but is uniquely applied in all those breweries, and that every ingredient and every detail, including water, has got the same quality and the same criteria that needs to be met all over the world. So for us, water is a very strategic issue, and it goes without saying that as part of our CSR program, which we introduced 5 years ago, which is called Brew a Better World, water is one of the 4 core areas, core pillars that we're pursuing, alongside with energy, with raw materials, and with responsible consumption. So in itself, we have a lot to do with water. We are constantly addressed by stakeholders, by investors, but also the broader stakeholder community. And we take this as a responsibility not because we believe by any means we must do good to the world. No. We are doing this because we believe it is part of our core business, and it is part of our risk mitigation program. And we want to make sure that in those breweries where we're investing a lot of money and that are in water-stressed areas, also in 5, in 10, in 15, and in 20 years, we will still be able to brew our beer according to the highest standards that we have.
And here maybe it's very interesting of what you once added when we were discussing the fact that the KPIs, if you're saying 5, 10 years, you know, on what are our managers today measured. If you need time with communities, etc., you need 5 or 10 years. You can't do it in 12 months. What is our situation today? Where do you see there a conflictual potential internally for managers like you?
Look, I've been in previous business that was actually taken over by Heineken. I was investor relations officer. And from that period, I very much remember this conundrum between short-term focus versus long-term focus. Funnily enough, and this was part of the preparatory conversation that we had, is funnily enough is when you think of water and when you apply it to the situation within the brewery and within our organization, then you meet very similar conundrums and dilemmas actually, where you have to talk to a general manager in Ethiopia, Mexico, Indonesia, and we are used within Heineken, we are used to incentivize our people for their performance, for it during a year, as well as for the performance in a 3-year perspective via the share program that we have. But for us, it is not that common to incentivize people on a 5 to 15 to 25 years perspective. And I believe in that respect, we are not so different from any other stock-listed business. And when you see that in the daily conversations, and once you are starting water stewardship programs, the sense of it is you need to have skilled people who are able to build the networks locally in the community, but you also need to take money in your hands for the solutions that you are then eventually applying them to the watershed in any given water-stressed area. And there you see the dilemma, because all of a sudden you're having this conversation with the local management, who of course understand the relevance for the next 15 to 25 years, but they also say, look, I mean, at the end of the day, I need to run a business, and at the end of the year, my performance is being measured on how much beer I sell, how much money I get, and what the profit is. And profit is, as you know, also determined by cost. So you're adding an additional cost element to that. How are we going to deal with that? And that is interesting, and that is we have got to used to that, and we are now much better than we were 2-3 years ago. But it also tells us, and it teaches us, that we need to look at strategic partnerships and look at partnerships on those who are skilled enough to help us organize water stewardship programs and connect with the local community, but also those who help us in the financing area and look for smart solutions that, how should I say, ease the pain for us financially.
Yeah, and I do think, Kate, it could be also something that could be added to a certain kind of review when questionnaires go out, no? Because, I mean, pressuring a manager on KPIs after a half a year, and still he needs to improve social community standards, I mean, something is not right, correct? No. And this puts stress on people and makes actually the whole mission impossible almost, right?
Yes.
And I think it's a very valuable input. And Piet, you were the whole time going like that, so I think there's something to say.
Now, yeah, you know, this is a familiar, you know, situation that I think all of us find ourselves in. That, of course, we're all rewarded on the short term. You know, that's true for people in finance, that's true for people in business, it's true for people in politics. Not unimportant, the latter, because a lot of this plays out in the public arena, and there you meet the same disincentives in a way to think long term. Well, you know, we're a long-term investor. Because, you know, that pension money's got to be invested in that basket, and it'll stay in that basket for years to come. So the way we talk with companies about this is that, you know, if water hasn't that ability to affect your balance sheet, your results in the short term, it has that strategic ability to affect your prospects for growth. The reason that CEOs perhaps should lose sleep over this is not so much because water gets costly all of a sudden. It's more that, in the long run, you may not have a license to operate or a license to grow. If you look at California, if you look at Sao Paulo these days, if you look at northern India, that is a very strategic concern. Now, strategy is there for the long term, obviously. You know, you may not see this back in the results of next year or in your bonus of next year, but ultimately it's the viability of companies that is at stake there. And, you know, when we engage with companies, especially in emerging economies, you know, the reason or the entree, the introduction is not so much, hey, here's another reason or another risk you forgot to worry about. You know, that is not the way to introduce this topic. A better way could be, this may constrain your ability to grow. And then all of a sudden it's more strategic. It's also not a minor issue within your own operations. No, all of a sudden it matters who else is claiming that water. And can that situation be sustained? Well, the answer in many regions around the world is no, it cannot. It cannot. So it's not an immediate financial driver, it's more a strategic, can we continue growing kind of driver. And if the answer to that is no, you can't, then hopefully you've got the ear of a CEO.
Thank you. Kajetan, share with us what you're doing day in, day out around water, where you come from with your thoughts, adding to this wonderful crowd of knowledge.
Allow me to pick a little bit from my various experience, but also listening carefully here.
Please do.
Maybe first, if I would be an outsider, not knowing about water stress, which still some are out there who don't comprehend it, it's really, we already have got now a water stress situation, but it will be enormous in the future. There's no way out. However, if I look more short term, as an investor, one conclusion could be, don't go there. It's too risky. As soon as water comes in, very complicated, so don't put your money in water. And if you have got those tools, which still, you need lots of knowledge. And still lots of moving parts involved here. Physical criteria were mentioned, climate change is coming in. Then water is also political, water is social, affordability, willingness to pay, all this comes in. And it only matters if you understand the real situation at that local place at that time. However, there's no way out, because there's this water, energy, food nexus, so whatever you do, wherever you put your money, pretty likely water is or a main stressor or a main enabler. And this is also what I want to underline here. So we have heard a lot about the risks, but I also would like to learn more about the opportunities and to put money there. Because next to a water crisis, we also have got a demand-supply gap in water. We also have got a demand-supply gap of funding. We're talking about millions, hundreds of billions a year, which are lacking to prevent a major crisis. So where does this money need to come from? Not from government, So next to the amount of money that's missing is also the type of money, because donor money or grant funding is not necessarily sustainable. It could create another problem. So we need the right type of financial engineering with incentives, disincentives, to prevent worse and to look for those opportunities. So this is something I would like to learn more about. Then also, in how far is a company, and we are talking about big companies like Heineken, or having worked with the 2030 Water Resources Group, so we have Coca-Cola, Pepsi-Cola. It's the only initiative where those two companies work together. They're at the same time at the same room. And they don't do this because they like each other. Then we have got Nestle, SEB Miller, we have got the World Bank, IFC, Asian, African Development Bank, WWF, World Economic Forum, SDC, ADB. So big organizations, and they are enforced to work together because there's no easy way out. And you have to team up, even if you're with your worst competitors. So I think this says something. And also, even a company like Pepsi or Coca-Cola is not capable to manage this within the fence. There are upstream, downstream problems, cross-boundary. So how to tackle this? So stakeholder engagement, cooperation is part of the solution, or if you don't work with stakeholders, you don't have got a good solution in your hands. So I think this needs to be stressed more. The company itself cannot solve it, even if it's a multinational. Or if it even could, to a certain extent, it's not accepted as such. Because then it might be accused for lobbying or whatever. So this all needs to add on. But actually I want to encourage you to put in more money in this sector. And the question is how to do it. What I was also missing here is a little bit the BOP. Yeah? So it's not only affecting companies, it's also affecting citizens, which means it affects the market, buying power, so then it comes back to the company. So how to work on those billions of people who lack access to water and sanitation, which is an ethical issue, but it's also a market issue. We talked about water bankruptcy, and it could start with citizens, trade-offs. So this is another play, so to say, and since this is an impact investment conference, so how could impact investment help to strengthen this environment? We have got other investors who are investing in listed companies, but what to do? What type of financial instruments do we need here?
This is a great question from the panel to the audience. So do we have someone that could help us here? If you have been listening, maybe you fell asleep. Hello? Any input? Please, thank you.
How do you view the stock exchanges as driving higher levels of disclosure?
I think they're, sorry, I'll jump in. I think they're a critical player in this entire game. Really, they hold an awful lot of power and sway, and we very much welcome the introduction of the principles there, and work with a number of stock exchanges around the world to help them understand where we've come from and what we've learned, to ensure that what is required to be disclosed is meaningful and useful and drives the changes that we need to see. As Piet said, it's very easy to simplify reporting down to accounting information, which is pretty useless for everybody. We have experience at CDP of requesting reporting that drives the changes that need to happen. So asking a company what proportion of your global revenue is at stake within each of the river basins that you operate, it takes the conversation away from the CSR team, because they certainly can't answer that question. Takes it into the finance and the accounting. That's a fundamental shift in behavior within the corporation. So we want to work with the stock exchanges all around the world to support their endeavors on this manner. It's very important.
And I do think here we come to a subject of the segmentation, of the trend where you also, Cyrus, right, was pointing out the question once, how is a company actually integrating the subject sustainability versus segmentation, where you say 2 people are doing sustainability and 10 people are doing plain vanilla, right? So how can that then be an integrative model on sustainability? Is it then more marketing? Or Piet, you wanted to say something? I'll leave it a little bit up to.
Yeah, I think you're all impact investors, or in one way or the other associated with impact investing, right? And you may think, this is all about risk and disclosure. This is a far cry from what my job or my responsibility, my concern is. But I think there's a link here. You know, the way we look at it, you know, we need to first make big companies, big listed companies, understand that water is in fact a risk. You know, you need the risk awareness first, amongst companies, but also amongst investors. Next thing is that you start thinking about solutions to this. Well, some solutions indeed are about increasing your own water efficiency. Very quickly, you'll discover that you can't quite out-efficiency this problem, right? You can't quite engineer yourself out of this by becoming more and more and more efficient. Ultimately, your environment is going to matter, whether or not you have secure access to water. This is where, you know, things become even more interesting, because then a company, once it is aware and awake to this water risk, starts lobbying for governments and water management authorities to get their act together, which in many countries they don't. It also means that they themselves start investing in solutions, and hopefully, through governments, start investing in more systemic solutions. Now, for PGGM, you know, we came under the same kind of pressure. Investors are relatively good by now at not doing evil stuff. Then we engage on slow and incremental increases. For PGGM, that's not good enough. Our clients want us to also invest more in the good stuff, the solutions. Before a year or so ago, we called that targeted ESG investments. Nobody quite knew what that was. We relabeled it into investing in solutions. We've picked 4 themes around which we want to concentrate those investments: climate, water, health, and food. So water security and food security, healthcare, and indeed solutions to help mitigate and adapt to climate change. The ambition of our main client is to quadruple those investments. So it'll go from what is currently about 4 billion euros to something like 16 billions and perhaps beyond. The challenge then is to find investments that are at scale. You know, we can't invest current assets under management, 180 billion or so, in slices of $50,000 or even $1 million. You know, no, it's got to be much bigger than that. What are interesting vehicles then from a point of view, an impact investing point of view, but then on an institutional scale? Things like green bonds or blue bonds, if you want to confine this to water. These are vehicles that allow us to invest hundreds of millions of dollars, billions perhaps of dollars, in solutions. Once the demand is there, once the returns are going to be there. We can't throw good money after bad. You know, we can't invest just for the fun of it. We're not a philanthropic organization. But the desire to see the investments serve real needs and to invest in real solutions to real problems is definitely there. We don't have to be the smartest actor on the marketplace. As long as we can finance our liabilities, we're good. So we're relatively patient. We're relatively modest in our financial targets, and we're quite keen on doing the right thing at scale. And yeah, this is why we do rely on perhaps people in this room here. You've got the ideas. Once you can aggregate them in something that we can invest in, we can be good friends.
Thank you very much. Cyrus, with respect to the engagement coming from the improving actually the ESG standards within companies, etc., or Cate, I mean, you have also declared a little bit that the ESG engagement or the engagement processes of company have not been really been transparent to say research or analysis of people like you. And could you specify that a bit more, or could you also maybe outline a little bit more what would be great if the development would go more into a complete direction?
Right.
Thank you.
Well, I think this actually connects back to the point about the stock exchanges integrating this and raising awareness among investors. I mean, the primary purpose of that is to raise awareness among companies and enforce standards that are mandatory for companies. But it also similarly impacts investors. Investors operating within those regions, Singapore, South Africa, whenever we have like a government regulation, new sustainability reporting standard, either by a stock exchange or a state pension fund, that's going to raise awareness among investors. And we're going to see increased demand for engagement opportunities, but also for the data itself. And we also, I was making this point with Cate earlier on before this panel started, but one of the interesting dynamics that we've been noticing is that within these markets that are newly getting acquainted with engagement or newly getting acquainted with the integration of this data and just starting from a complete blank slate, those are the most malleable investors. We can start with a blank slate and basically provide them with the guidance that they need to actually integrate these factors without actually having historical biases in mind or having historical processes in place. Because we generally find those historical processes actually might impede the engagement process and actually the integration of it.
Can I build on that?
Please,
Danny? So
please
I
do.
think,
Okay, thank you.
We mentioned, Cyrus mentioned about the importance of standardized reporting, and of course the stock exchange intervention is a really important one, but what's happening right now in Europe, right across every member state, is the introduction of a mandatory requirement for non-financial information to be integrated into financial reports of any company that has more than 500 employees. It's an amazing opportunity actually to drive better corporate action and to achieve greater ESG sort of performance, I suppose, from each of these companies. What's important, and I would ask anybody who may be in a position to advocate your local governments within your countries, is that this standardization of reporting may actually weaken because each member state has a choice as to what is reported. And so if you're, as I say, if you're in a position to lobby or advocate for standardization of reporting, please note that down and bring it up at your next meeting. And I also wanted to mention about the idea of impact. And I think it's important for everybody in the room to appreciate that that's, for water, that's really the next frontier. How do we know that all of this work, all of the effort, the wonderful work that Heineken is doing is ultimately reducing their impact and reducing their risk exposure? It's actually really very difficult to say for anybody to quantify that in a meaningful manner at the moment. CDP is working with the Nature Conservancy and the UN CEO Water Mandate to try and put some thinking around this concept so that we can ensure that CDP and others can then ask that question, well, how do you know, Heineken, that the 100 million that you've invested has really led to the change that you hope to see? We want Heineken to be able to say with confidence, well, this is how we know, this is what was happening. That is going to be the next frontier over the next few years, I think, and we'll no doubt be working with Heineken and lots of others to better understand how, if at all, that is actually possible at such a small, relatively local scale.
Michael, shoot in, please.
Being on the giving end, so to speak, of providing data and information, and having been now in this particular position for almost a year, one of the things that really surprised me is the sheer number of surveys, of benchmarks, of indices, all sort of stuff that you need to fill in from a company side. And working, and you know what I mean, working in the sustainability area is by definition, you always need to explain that when you're talking to your colleagues from commerce, from supply chain, that you're one of the good guys. You know, you're not one of the greens who wants to change the world. No, you're also part of the business. So talking about efficiency and being as professional as you can as a company representative, and then I'm taking a look at my own team, and I have one business analyst, and her role is consumed for, at the moment, more than 75% by all sorts of benchmarks, and whether that's CDP, whether that's Sam Dow Jones, whether that's FTSE for Goods, whether that's Bloomberg, whether that's VBDO in the Netherlands, the transparency benchmark in the Netherlands, I could go on and on and on and on. So I would not want to claim personally that I'm not the expert to tell you should either follow this one index or the other one, or we should have eventually only one benchmark, or we should have three, or whatever. The only thing that I see is for a reputable company like Heineken, and there are many companies who are in our league, so to speak. The sheer amount that we need to deal with reporting, and in the past I've also incidentally worked in reporting and finance, so when I compare to what we did in the reporting area once we had the IFRS standards, and I compare to what we are forced to do now in the area of sustainability, then I see a huge burden, an administrative burden, because we're filling in each benchmark, and all of them are sort of similar. But you need to focus each and every time your attention on each and every benchmark, because in one way or the other, they're all different. So it is an enormous assault on the capacity that we have, that I personally, looking at the team capacity that I have, would be very, very happy to spend on other topics than on benchmark number 12.
Well, Kate, we had a discussion there, especially today, because the motivation of companies, when you approach companies already, that they have the feeling that they have to rectify their existence, is not really making them engage. We were pondering a bit over the idea, why are 42% of the companies not really disclosing? And I do not think you can only say, yeah, it's because those companies are bad or something. I think it's because it's a highly... As much as we are all engaging, I think we have done a great job also to make it also a bit unattractive in several ways because of these issues of complexity, of bureaucracy, of, I mean, I could say, Michael, you know, you have different beers too, but it's exactly that. Everybody's trying to, you know, handle their standards. So it's not really a standardization for a global value. It's actually, it's a bit an ego trip of different brands, right? And there we do have an issue, I think, because I do not, and I'm a really a great believer of impact, etc., but I do not think that we will really get those 42% massively lower if we're not changing the handling of being sustainable. And yeah, I'm the moderator, so we are going to go further. Cyrus, input?
I think, Michael, you raised a great point, and as a research provider and analytics provider, I apologize for the surveys. But I think it gets at the point that a lot of the research right now is still conducted on a very local basis. We have local markets, we have different local research providers, local ways of looking at specific issues. Some issues in France are way more important than they are to investors in the UK or the US for that matter. So it's hard to get around that issue of having localized specific surveys or ways of analyzing the data or analytical tools to help investors get around that issue without actually taking that local perspective. I think the key is to actually take that local perspective, but do it on a global basis. So I mean, with MSCI at least, we're providing the same global model across all of our companies that we assess, trying to cater it to those local markets. But I think in general, we'll see an evolution towards more global providers and putting more pressure on the local providers to either adapt or
get out.
Yes.
Thank you so much, Cyrus. To the audience, questions. We had here a question, please.
I wonder about the indicator of the carbon disclosure that is planned. So will it also provide information on how many products of the company is coming from areas at risk, and therefore is also a signal, or another issue would be also to disclose the water risk of products or the water intensity in areas at risk. So do you see and do you know about this?
Yes, so we ask a range of questions. One, we ask companies to disclose by river basin the proportion of global revenue, the proportion of cost of goods sold, or the proportion of production capacity, I suppose, that's being created or linked to that river basin. That was the first time we've asked the question this year. And again, another important thing to remember is that companies aren't necessarily accounting financially at the river basin scale at the moment. So not many were able to provide the answers that we were looking for. But we hope that they are working towards establishing that system. From the perspective of, and our disclosure score, so the score that we will reward companies with next year, rewards companies for more points if they provide that piece of information to us. So you will score more points for being more transparent. Yeah. Very clever like that. Equally, we ask for companies in certain industries, so the issue of water intensity by products, we have one standardized questionnaire that is issued to every single company where water is deemed to be relevant, material, whatever word you wish to use. And so we have to be mindful of the types of questions that we put to them and the reporting burden that then happens as a result. Pursuing water intensity by products question is a difficult one that we've been playing around with for a few years now. For the likes of Unilever, it's a nightmare. For the likes of Heineken or Molson Coors, who might have 5 to 10 products, it's relatively simple for them to provide us with that data, but an organization with 570 different products, it's really very difficult for them to provide us with that information. And I would question how useful that is to you as investors really at that level of granularity. We do ask at the moment where if company is identified a specific facility that is exposed to risk, we ask them to provide certain elements of water accounting information that can be used by you then to inform your own risk assessment processes and procedures. And again, we incentivize through the reward of points. The more transparent and more granular companies are, the more points they will receive.
Thank you so much, Kate. I thank you all for listening to us, and thank you for your interest. Thank you to the panelists.